Hi, I'm Matt Lodes, the U.S. Insurance Tax Leader, and this is PwC Tax Insights in Brief. Welcome to our discussion of H.R. 1, the One Big Beautiful Act, recently passed by the House. I'm joined today by Ben Tausig, and we'll be discussing the bill's potential impacts on the insurance industry. It is important to note that while the House package is an important milestone in the reconciliation process, the Senate is now taking up the bill, and the House and Senate will need to agree on a final identical version of the bill that can be approved by both chambers. So there could still be some significant amendments to the bill prior to becoming law. Ben, with that being said, let's start our discussion today with some of the things that the bill wouldn't change or would largely extend. Can you highlight a few of those items?
Sounds good, Matt. The House bill would not change the corporate tax rate of 21%, nor would it change the stock buyback excise tax. In addition, the House bill would permanently extend, with some modifications, key individual tax provisions, including the lower individual income tax rates. Finally, it would extend permanently and modify slightly the current rates on GILTI, FDII, and BEAT. The bill therefore would provide more continuity and certainty for purposes of business planning within the insurance industry.
Thanks, Ben. Now let's dig into some of the items the bill would change. For example, along with the temporary reinstatement of the deduction for US based research investments under Section 174, the EBITDA based business interest deduction limitation under 163J, and the 100% bonus depreciation allowance under Section 168K, which were expected to some degree, the House bill would respond to certain global tax regimes in some pretty unique ways. Would you mind delving into this?
Sure, Matt. Section 899 is a new proposed retaliatory measure on a discriminatory foreign country that imposes an unfair foreign tax. An unfair foreign tax is proposed to include an undertaxed profits rule, a digital services tax, and a diverted profits tax. An unfair foreign tax generally would not include a tax that applies neither to US persons nor controlled foreign corporations majority owned by US persons. Notably, certain subsidiaries of tax residents of discriminatory foreign countries are applicable persons, so that foreign corporations that are not resident in an unfair tax country may, in any event, be subject to Section 899. However, generally, foreign corporations, at least 50% of whose vote or value is directly or indirectly held by US persons, would not be considered applicable persons. The proposal would increase US net income, withholding, and gross basis tax rates on residents, including certain their subsidiaries and governments of those countries, by 5 percentage points per year, up to a maximum rate of 20 percentage points above the applicable statutory rate, and disallow an exemption for foreign governments. With respect to income that is eligible for a reduced rate of tax under an income tax treaty, the proposed Section 899 surtax would require an increase to the rate of tax that otherwise would be applied under the treaty. For example, in the case of distributions that are eligible for a 5% rate of US withholding tax under the treaty, Section 899 would apply to increase the rate of tax on the distributions from 5 to 10% in the first year of application of the provision. This tax rate would increase at 5% increments each year thereafter, up to a maximum of 20 percentage points of increase above the rate of tax that would apply to the income without regard to the treaty. For example, up to a maximum rate of 50% in the case of distributions or other income subject to a 30% rate of tax under the Internal Revenue Code. The House Budget Report makes it clear that legislation as drafted would not apply to the portfolio interest exemption. In addition, proposed Section 899 would make several modifications to the BEAT rules, including eliminating the $500 million gross receipts and 3% base erosion percentage thresholds in certain cases, disallowing all general business credits, treating related party expenses that are capitalized into the cost of goods sold, for example, qualifying interest or royalties as base erosion payments, and denying the services cost method exception. In addition to these modifications, US companies owned by applicable persons would be subject to the BEAT, generally at an increased rate of 12.5%. The proposed Section 899 modifications to BEAT would only apply to US corporations if more than 50% of the vote or value of their stock is owned by the applicable persons. Groups should pay attention to the proposed effective dates and safe harbors which will be of interest to US headquartered publicly traded insurance groups as well as foreign owned insurance groups. The proposed amendments would potentially bring more foreign owned insurance groups within the scope of BEAT, given the prevalence of related party reinsurance.
That's a lot to consider, Ben, and it could have significant impact to foreign based insurers. If that wasn't enough, the House bill would make numerous changes to the Inflation Reduction Act tax credits and related transferability provisions. Insurers have both invested in IRA tax credits and also provided tax credit insurance to third parties. The proposed bill, however, introduces substantial cuts through acceleration of the phase out schedules, restrictions on foreign parent entities claiming credits, and elimination and transferability of certain credits. So, to this point, we have covered some things that the bill wouldn't change or would extend, and some of the things that the bill would change. As we discussed previously, the House bill needs to work its way through the Senate, where it could still see significant changes to the bill. As the legislation progresses, insurance companies should consider whether to pursue opportunities to influence the legislation as it advances in the Senate and begin to prepare for the future by modeling what if scenarios they could hit the ground running. We've covered a lot today, and we will continue to monitor the bill as it moves through the legislative process, keeping you up to date as things develop. Thanks for watching. This has been PwC's Tax Insights in Brief.